Hey, I want to welcome you to another episode of Money Matters Top Tips for Success, where each and every day I bring on new business owners, entrepreneurs, and executives and have them share their top tips for success with you. My name is Adam Torres. You can follow me on Instagram at AskAdamTorres to keep up with my book releases, book tour schedule, signings, all that other good stuff. Always love to connect with you there. And as always, if you'd like to apply to become a co-author of one of my upcoming books, just head on over to the website, moneymatterstoptips.com, and click on Become an Author to apply. All right, so today is a very special Reunion 2020 episode. That's where I bring on a guest that I had on in the past, and I just couldn't get enough of them, so I brought him right back. Today's guest is Chris Mooney, who's managing partner over at Cider Moon Investment Group. Chris, welcome back to the show.
Thanks, Adam. Pleasure to be back. Thanks for having me.
All right, so I'm excited about today's book. We're going to be talking about bridge debt, institutional money. We're going to get all into what it takes to move real estate. But before we do that, let's get into a little bit more into what you're doing over at Cider Moon Investment Group. So first, tell us a little bit more about the company, please.
Absolutely. So we're owner-operators of multifamily, everything in the Southeast. We just closed out 2019. We did about $80 million in acquisitions in that year. We were totally net buyers. We did not sell anything, but I feel like in 2020 we're going to be net sellers just because things are coming full circle with our value add plans, and bridge debt terms are coming up. So, and it's still a great market to sell, and there's a lot of buyers out there. And trust me, it's so competitive. But being net buyers this past year, we learned how hard it is and how competitive it is out there. But it's good to be a seller, and we're still going to look at some things to buy too.
That's awesome. And for people listening, what's the right type of investors that you take on?
We started out years ago just doing friends and family and trying to make people that are close to you a few extra bucks. And at that time, that's really the only people that will trust you, even if they don't fully. But you can still get a few dollars out of those people. And since we've grown, we have to prove ourselves and show a lot of track record and coming full circle and high IRRs and low kind of hold periods in order to get some more institutional and fund type investors. And, whether it be pref groups that want a current pay, which is a little tough to do when you're doing value add and you need all that working capital to be, laying out money, even if you get reimbursed by a lender. You need people that aren't tied to kind of one bucket or one vision that they can only see from the inside of an office. I like people that want to come out and see the property, see the value that's there, and look at the comps and see why there's a delta and why there's some arbitrage to be had, as opposed to just running numbers and sitting in an office. Especially because everything I have is in the Southeast, and I'm usually talking to people in the Northeast where I'm out of. But, I like people that want to get their hands a little dirty and head down there and, see these places for themselves, and then they can kind of see my vision, and then they feel a lot better, putting some equity into a deal.
That's awesome. Let's switch it up a bit. Let's get into debt. So what's your overall view on the market now?
Yeah, I mean, the bridge debt market has become so competitive, and the rates are so low. It used to be this big, scary thing, almost like loan shark status, 10, 12%, and totally over-leveraged, and people would get so worried about it. But now everything's kind of, depending on the deal size, you get LIBOR plus 250, which at this point is...
Wow, really? That's pretty low.
Yeah, everything we had is in the mid to upper 200s in terms of the spread over LIBOR. The problem that we're having is kind of the rates are so low, and you can get 80% LTV and 100% of your CapEx budget financed. So at the end of the day, even though closing costs and some other things are higher with bridge debt, it ends up being 76, 70%, 77% LTC. And when you're doing these larger deals, we can only come up with so much equity ourselves, and then you're looking for an institutional partner. And it's almost impossible to bridge the gap with that equity that you need when you have like that high leverage. So almost every group I talk to doesn't want to be behind X amount of debt, even if, whether it's a pref group or just a common equity group that has, a waterfall kind of GP, LP calculation at the end. the leverage is seen as kind of like a bad thing still, or risky, or but the way I look at it is that we need that much less equity. You get that much higher return on your money. It's a lot easier to double $5 or $6 million than it is $8 or $9 million, and it would be the same deal. It's just kind of these institutional groups, they just plug in numbers, and if it doesn't fit the kind of calculation, then they run for the hills, or they want you to take much less debt. And debt's at high 4% or 5% is a lot cheaper than the pref rate that you have to pay them at 12%. But they just don't like being behind that leverage, even though that's when we have our most success. And there's a lot of things you can put in there that still keep it conservative, even with high leverage, where you can overraise the equity and have plenty of reserves and things that you're never not going to pay the mortgage, especially in kind of the Class C and D arena that we're in, where I feel like we're protected even if there's an economic downturn or anything like that. It's just as we're growing, and we need that kind of institutional money to get to the next level. 70% LTV as opposed to 80% is like the preferred method, and it almost ruins deals or makes them not worth doing because the IRR drops so much because you need that much more equity, especially on a $40 or $50 million deal.
No, it makes total sense, and I know that placement of being behind other debtors, that's a big deal to institutions. And like as you mentioned, they have their metrics. That being said, what do you see kind of going into 2020? We're starting the year, brand new year. What do you see as kind of taking place in the market overall?
Just a lot of buyers still out there. Everything's still going to be competitive. You got to look for the off-market type of deals and use your network of brokers that you worked with in the past, or management companies that we work with now that manage for other owners that are looking to sell, and they want a quick transaction where they don't have to deal with a broker. And management company has been a way, because they know that we'll keep them on as management if we take over, as opposed to going to the open market and somebody else buying it who potentially would use somebody else. Just really being resourceful, and it's you got to be gritty out there just to put hard money down if you have to, if you really like a deal, just to set yourself apart if there are some other bidders on the deal. And like I said, we're probably going to be net sellers, so we have the same trusted people that we look to get deals. We're going to trust with finding some qualified buyers, and hopefully not even putting our stuff on the market, because I don't want to lead through some people that are going to offer a big number and then retrade or not get their financing. I mean, we want to return the favor to the brokers and the people that are giving us these off-market deals by giving them our deals back in return. And it just kind of works in a good kind of cycle like that, where you're constantly helping each other. And as long as you're trustworthy, and then that they're willing to recommend you to other sellers when you want to buy, then the same thing will be given to you in return when we're looking to sell. That they'll bring us qualified people that don't play games, and everything will be a fair kind of transaction. So that's what we're looking to do this year.
And you mentioned your properties are primarily in the Southeast. Any areas you're liking in 2020?
Yeah, I mean, it's getting because it's getting so competitive. We have a bunch of stuff in Atlanta from 2.5, 3 years ago where it was a 6.5, 7 cap, and now everything's below a 5 cap. So it's good to be selling there, but we're not necessarily looking to buy there unless we can get a real sweetheart off-market deal for a good price. But we've been expanding into just more what people would consider tertiary markets, or not the sexiest of names, just because I think that's where the opportunity is. And when things get expensive, then people are going to move to the markets eventually, and we kind of always want to stay ahead of that curve, and not, we kind of want to set the market and not wait. We're very conservative, but we also not, and we're very patient, but we don't want to, we're not afraid of going into a market and proving something can work there, and then letting everybody else follow us, as opposed to letting somebody else take that bit of risk and then we follow them. So we bought a $34 million deal right at the end of December of 2019 in Baton Rouge, which is outside of our normal kind of big sexy names. But LSU won the national championship in football, and there's a lot of good metrics in that area, and it might not be the sexiest thing, but we really like it, and it's kind of a hybrid of student and conventional tenants, and we're kind of moving more towards the conventional side, just because the rent ceiling and the comps, people are paying a lot more and getting a lot less in worser areas right around where we are. So we're kind of just going to use that trend, and we got some CapEx dollars to put it together and do some renovations, and we really like it. So we're not afraid to move into different markets in the Southeast that are, it's still a capital city. It's not the middle of nowhere by any means, but it's not on the top of everyone's list. But those other markets have become kind of safe, and the arbitrage between buying and selling at a high cap rate and selling a low cap rate isn't really there. It's all kind of corrected, and just the competition's crazy, and so we're not afraid to move into different areas that still have a lot of potential.
That's awesome. So, Chris, if somebody's listening to this and they want more information on Cider Moon Investment Group, what's the best way for them to get that?
Yeah, they can go right to my website. It's cidermooninvestments.com. We constantly update it with what we've added recently to the portfolio, and it kind of lays out the whole investment strategy and how to get in touch with us to see if we can make something happen in this year and beyond.
Fantastic. Well, hey, Chris, again, great having you back on the show. I'm sure I'm calling you back in 2021 to see what the update is going on now, but for now, that's all our time for today. And to the audience, as always, thank you for tuning in. Hope you got a lot of value out of this. If you did, don't forget to subscribe to the podcast, leave me a review, do all those great things we do to support our podcasters. And Chris, thanks again for coming on the show.
Yeah, thanks, Adam. Have a great one.